Have you ever had a friend tell you about the amazing amount of money that they are making on rental properties? It can sound really alluring. Passive income, an appreciating asset, low time commitment. What could go wrong? Today, we want to explore the realities of what it looks like to actually own a rental property. So, Spencer, owning a rental property can seem really alluring. Just like what we talked about, there's passive income that you can make. Oftentimes, real estate appreciates in value, but that's not always the case. Sometimes you can get into really complex and challenging situations when it comes to rental properties. I know this. My wife and I owned a rental home for about 6 years, and most of the time, I would say most months of the year, it was great. We had great renters, we had some friends that lived with us, friends that lived in our home, and it really worked out well. But when it didn't work out, it was really painful.
And Austin, you didn't even have to evict anybody, and you still had months that it was really painful. So we'll talk about some of those even more challenging times that can really make even 4, 5, 10 years of a great experience turn sour in the course of a couple of months.
Absolutely.
So why you should own a rental home? We're going to go there first, talk a little bit about passive income. So help us understand, what is passive income?
Yeah, so passive income, you can think about it in contrast to your active wage income. So when we show up for work, we do a job and we earn income from that job. That is active income, it's earned income. Passive income is different. When you own a rental property, if you're not a real estate agent, that is, and you don't have multiple rental properties that are taking up a majority of your working time, it's passive income. You're not going to the job site every day and putting in the time and effort. You're simply receiving an income from an investment that you have made.
Now, this feels like a little bit of a misnomer sometimes, though, because most of the time it's passive, but there are some times that you have to do a fair amount more.
Yes.
Because if you have an account that has stocks and you receive dividend income and they just send you a 1099 at year end, that sounds a little bit different than getting a call at 2 a.m. that something's going wrong with, the roof.
Right. Or that a security camera needs to be installed because someone came knocking on the door at 2 a.m. So things like that you don't get those calls from the companies that you invest in, but you do get them from tenants.
So what we hear is the government considers it passive income, but you're doing a little bit more typically than these other kinds of passive income.
Yeah, exactly.
Okay.
So that's one of the things about it is, if you have multiple properties, you can offset some of that passive income. So if one of your properties does really well in 1 year and the other one sits vacant for 6 months, you can offset those gains with losses in passive income buckets.
So if things go really well, what would be another benefit?
Another one is just a high rate of return. So let's think you bought a property 20 years ago and it has a low cost of ownership, low expenses. Maybe let's say you can rent it for twice as much as your expenses are. Well, then there's a high rate of return. And if that property was in a place where now it's appreciated in value and you can sell it for an appreciated amount, then there can be a really high rate of return on rental properties. This isn't always the case, but sometimes if expenses are low and income is high, it can be a really nice generation of income. The other piece is when we think about tax advantages. When you buy a property, the IRS gives you a requirement, if it's placed into a rental property, that you have to take depreciation on it. And so depreciation is a capital expense. This comes from the IRS website, and it's the mechanism for recovering your cost in an income producing property and must be taken over the expected lifetime of the property. And so what the IRS says is you've got 27 and a half years to depreciate your property. So just by way of imagining this, you could say we bought a home for $160,000. We put $60,000 into it. We've got $220,000 of basis. Over 27 and a half years, you take that 220, divide it by 27 and a half, you can take $8,000 a year as a depreciation expense. So let's say you make $20,000 in that rental property. You depreciate $8,000. That is an expense for running the business, for running the property. And now the expense on that, when you go to report your income to the IRS, it's been deducted. So even though you brought in 20 of income from the rent that you received, it's deduced down to 12,000. So 20 minus the depreciation gets you down to 12. There's other expenses that you can put in there. Property insurance, mortgage interest, cleaning and maintenance, utilities. Now this kind of gets into the other piece of it, is if you've got a whole lot of expenses that maybe you think you don't really consider on that outset. Okay, what happens if an HVAC unit goes out? What happens if we don't have a tenant? That's where it can really start getting sticky. But we do want to say there are some nice tax advantages to this rental income.
So in essence, you're going to have cash flow oftentimes that is above and beyond what you're paying tax on because we get this depreciation component of it.
Right.
So now, boom, boom, boom. Let's go to the why you shouldn't own a rental home, or what are some of the disadvantages that you've seen?
Yeah, absolutely. So let's take market volatility. I'll give 2 actual experiences that we had. So pre-pandemic, we had moved across town in Knoxville, and so we were renting our home. Again, by and large, we had friends live in it. But there was one portion of the property that we were able to rent out independently, and so we typically had different people live there. Well, it went about 2 months where we couldn't find a renter. And then when we finally did, we had a renter that was terrible. He regularly paid rent late, which in some ways was nice because we got to charge him a late fee, but I would much rather receive the income on time than the additional 5% fee. So we regularly paid rent late. We had furnished the apartment because it was just easier. We had some extra furniture. We had had some international friends that had lived there at one point. So we were like, let's just leave the furniture in there. The furniture was all trashed by his dog when he left. And so not only was he paying late, he didn't pay the last month's rent, and he trashed the place. So that's one scenario where it was just a terrible experience for us. Late rent, didn't have it rented for a couple months. If we relied on that income for our daily living, then 2 months gone, it would have really hampered us. We were getting to that place where it was kind of getting close to that, but thankfully we had the renter come up. Now, on the flip side, when that tenant moved out, we couldn't stop the applications coming in. We had maybe 30 or 45 calls to rent the place pretty much when we listed it. And so there's the reality of market volatility. So if you've got a place, then maybe it's easy to rent, but maybe it's not. And maybe you get a great tenant, but maybe you get a terrible tenant. And then the reality is tenants have a lot of legal protection. And so if you're going to try to evict, you have to have a whole lot of list of circumstances of why you are trying to evict this person. And you have to take it to the city. The city has to review it. They may take 30 to 60 days. Well, if you've got a tenant that's living there, using your utilities and not paying rent, and they've got tenant protections, it can be very challenging to evict somebody. And then you got to think, am I going to incur legal fees to then evict this tenant? And so really there's a high bar where you can say things can go really wrong. Because if let's say you only have $20,000 of income coming in from this property, and now you've got a couple of months of lost rent, damages to the property, and now you've got legal fees because you got to evict somebody, well, there's a lot of expenses that can really quickly eat into potential profit therein. Right.
Well, and just having watched that eviction process go through with another friend who's out of state, that takes not just all of the expenses that you were talking about, but also just the emotional energy and the time to jump through all of the legal hoops to still try to correspond with the tenant, all those kinds of things. It is a heavy load.
Right. When you talk about time commitments, let's just bring that up in general. We got a call on Christmas Day when it iced over here in Knoxville and it was really cold that one of our pipes had burst.
Oh gosh.
So we're driving to our in-laws' house to go spend Christmas with them, and we have to stop and dig a trench in our backyard where there's just water sitting, turn off the water, get everything fixed. This is not how I want to spend my time as I'm going to spend a holiday with family. The reality is things are going to break. You're going to have a leaky faucet. You're going to have a fence that needs to be repaired. You're going to have a lawn that needs to be mowed. Who's going to do those maintenance? If it's not you, then you're going to have to pay somebody to take care of that maintenance for you. You may really enjoy it for a couple years because it's 1 call a year, 2 calls a year, but there may be a year where it's 5 in a month, or it's just challenging. And so then you have to start thinking about, okay, how am I going to price my time? Is my time worth $50 an hour? Okay, that's fine, but then let's expand that out. If you're spending 4 hours a month on average in repair time, are you willing to pay yourself that $200? Now, you're paying it by that income, but is your time worth it? to have to go over there and repair the leaky faucet.
Well, and you've got transit time to get over there, and you really should be paying yourself overtime because it never happens at 3 p.m. on a Thursday when you can get over there easily. It's always going to be some evening or another time that's inconvenient, so it's tough. I remember a conversation I had 10 years ago with a friend who he was telling me about all the money that I could make in real estate. He said, I bought this home and I bought it for $50,000 and I put it in another $50,000 and I think it's worth $150,000. I said, well, that's great. Who did the work? He said, well, I did the work. I said, well, how long did it take you? Well, most of last year. He said, so what else were you doing during that time? It turned out that had been his job, basically, for about 10 months. And yet he was mentally thinking, I've made $50,000, which he still hadn't sold the home, but he had not accounted for all of the time that he had put in. And that's one of those things that people will typically undercount at the start. And then sometime when that time commitment becomes just overwhelming, start to realize, oh, I've been putting tons of time here. It may not be as valuable as I thought.
Right. And let's come back to finding tenants. If you're going to try to find a tenant, they want to schedule not when it's convenient for you.
Right.
So you may have to be able to have an open house or these other things, but you still have to go there when it's inconvenient. You have to do interviews. You have to make that time. When we had 30 people apply for the property, I had to receive 30 calls and make callbacks and all those things. It's just a time commitment that you really have to keep in your back pocket. So one of the other things is, if we think back and say one of the positives was tax advantages, well, there can be some tax disadvantages too. So when you think about selling a stock or a bond, anything that has had capital appreciation, you pay capital gains tax. And by and large, that's what happens with property, is you'll pay capital gains tax. But wait, you, dear viewer, know about Section 1250 property. Section 1250, that benefit that you received, that tax deduction for the depreciation, is now going to be recaptured by the government. So let's presume that you are in the 22% earned income tax bracket. You're going to be in the 15% capital gains bracket. You may have 3.8% net investment income tax, but when you go to sell your property, that Section 1250, the depreciation is going to be recaptured at your ordinary income rate. So that means if you've held a property for, let's say, 10 years, you have $8,000 a year that you were depreciating. Well, now you have $80,000 extra dollars that's going to be taxed at your ordinary income rate, not at your capital gains rate. So let's just say this person doesn't have net investment income tax. That's a 7% delta between 15 and 22% that you've got to pay on that first $80,000 of depreciation taken. And so the government wants their money back. They said, we've given you this benefit. Now it's time for us to get that benefit back. So there's just that reality that, it was a benefit for a while, but at some point it's going to come back to you. And so let's just presume that maybe you bought the property when you were in a low tax bracket. Well, now if you've been taking those depreciations at that low tax bracket, but now are in a higher tax bracket, let's maybe say you're not in the 22, maybe it's the 24 or the 33. Now you're going to be taxed in that depreciation recapture at your highest level up to 25%. And so it can be really punitive. So just something to consider as you are owning these rental properties.
So as we think about this and we try to frame it in light of the possibilities and what we need to be expecting, what would you say if someone's still, despite all of these caveats, despite the challenges that could be there, what would you say would be key things that you would prioritize looking at for success?
Yeah, do your research and don't stop learning. It really is important to know kind of all these factors of, okay, what are my income going to be? What's my expenses going to be? It's something we didn't really cover a whole lot, but let's say your income is $24,000, but you have expenses of 5 to 10. Well, if you've got maybe 2 years in a row where you have to replace an HVAC unit and a fence, and that costs another $10,000, well, now you may only be making $4,000 to $5,000 a year on that property. And if it is even higher, you've got to consider taxes. Are you paying taxes on estimated quarterly taxes? Your renters aren't paying taxes for you. You've got to pay taxes. And so really you have to do your research. You have to know all of these different facets when you get into it. Because if not, things could really come back to bite you at the back end.
Well, and it would seem like it's actually a little bit easier, more effective if this is kind of your job.
Yeah.
So I have seen success among folks in this area, but it tends to be folks that say, actually, I don't really like this other job that I'm doing. I have enough capital here to make a purchase of a half dozen homes or something like that. I want to grow my portfolio. Because the reality is, whether you own a dozen homes or you own one home, if you have to evict somebody, you have to know the same things. Mm-hmm. If you have to walk through a dicey process of hiring contractors for HVAC or for roof repair or whatever, the first time you do it, you're probably not going to do it that well because there's a learning curve there. Yeah. But the second, third, fourth time that you do it, you're going to be in a much better position because you've learned enough. Mm-hmm. There, which gets to your point, about always learning. Yeah. There's some of us, like myself, that we just don't want to take that step to have to learn all of those different elements in another field because there's enough going on in life otherwise. Right. So, making sure that area of expertise, you're actually going to be able to leverage that beyond, say, one home. Tends to be one of those success factors, I think, when we think about our time.
Yeah, absolutely. And that comes back to one thing that we often tell all of our clients. Diversification is really crucial. Mm-hmm. If you have one investment, whether it's one stock and that holds all of your money, right, or one home and that's your only primary source of income, mm-hmm, there's a lot of risk there. But if you can diversify across a broader pool, then it can make more sense. Right. And I would say the other piece there is consider hiring an effective property manager. Mm-hmm. They're not going to do everything for you, but they will be your first line of defense. You're not getting that first call. You're not screening tenants. Mm-hmm. There's going to be a cost to it. Mm-hmm. And so again, if you only hold one rental property and the cost to have this property manager is maybe 2% or higher, then you really have to consider, okay, is it worth that fee? Mm-hmm. Is that fee worth what I'm getting out of it? But if you've got 20 properties, mm-hmm, well then, yeah, maybe a whole lot more easy to justify whatever that fee is. And so really, if you've got slim margins, a property manager doesn't make sense. If you've got a little bit more space, it can make sense. And then they can suggest things that you can do to improve the building or improve the property. But the reality is it still falls on your shoulder to either do the work or hire the contractors.
Well, thanks for walking us through all of that. We hope that you found value in our conversation about whether you might want to own rental property. As always, if you have any questions, don't hesitate to reach out to us, and we'll look forward to seeing you next time.
If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.